if you're anyone who wants to do something, especially in real estate development, let me just say rent a quarter, that you're sitting down and talking to someone from your government about what your priorities are, what you're looking for, and what they can do for you.
So what systems allow you to juggle all of those roles while keeping each machine running coherently?
You have to specialize in what you do best. Within those 5 or 6 different categories, what do I do the best? And then find people in those other categories that you can trust.
What should investors look for before investors start coming in and prices begin to rise?
Right now, you need to be asking for the things that they want to see by 2050, because the government is going to give itself plenty of time. Finding that out and getting in and getting land in those areas is going to help you to be able to get the financial return that you really want.
What do Somali piracy, real estate investing, and $6 million in community grants have in common? Well, they're all part of this man's story. Today's guest is Dr. Chris Daniels. He's the founder and CEO of Smart Capital, a real estate investment fund and educational platform helping hundreds of new investors create generational wealth. He's not just buying houses. He's building communities. He owns over 200 rental units, teaches real estate at Cornell and SCAD, and has helped secure millions in public and private capital to help uplift underserved neighborhoods. So let's get into it. Dr. Chris, let's start at the beginning. How's it going, man?
It's going good, man. Excited to be here. Thanks for having me.
Let's start from the beginning. Your journey from academia into real estate. Chris, your background is really unique. You have a PhD in African studies. You are a former professor and now a real estate investor and a fund manager. So how has your academic rigor influenced how you build investment systems at scale?
Yeah. So one of the things that you learn in academia is to do your research. So you research, and what you do is you research best practices. So what I do is I will research people who are doing what I want to do and look at how did they do it, and then just not reinvent the wheel. So it's okay. You see other people doing this, they're building this, they're charging this amount, whatever, just get all the numbers together and then be able to do that. The thing about academia and about being a professor is that in order to be a professor, you have to be seen as an expert. You have to be seen as one of the smartest people in the world in what you do. The same thing applies to the investment world. In order for someone to invest with you or trust you with their capital, you need to display competence. You need to display the fact that you know what you're talking about and you're one of the best in the world, the best in your city, whatever area at what you're doing. So it's literally the same skill set. So in academia, we do a lot of research, we read papers, we read books, we go to conferences, same thing. So with real estate, you read case studies, you go to conferences, you network with other builders, you do a lot of other things, but you basically do your research and you build a network of experts around you. And then eventually you become that expert because you get experience. That's what makes it work. Now, the good thing is about real estate development is that there's such a shortage of housing in America right now. I think we're short 12 or 13 million units that are needed across the country, that there's really unlimited amounts of homes that you can build. I mean, none can build that many homes. It's going to be a big process.
At Smart Capital, your mission is to help first-time investors scale portfolios that create generational wealth. So what's the leverage mindset that you teach most beginners that they tend to overlook?
So the biggest thing people have to understand is that you have to invest, but you have to invest with people who know what they're doing. A lot of people's biggest mistake is that they invest with people who don't know what they're doing and don't have the experience and have not done what they propose to do. And that's a big mistake because absolutely you're gambling. You're gambling with them and you're gambling with your own funds. So what you got to do is you got to invest people who are more experienced. Now, people who are more experienced typically are going to offer a little bit lower rate of return to people who are less experienced. You're not going to double your money, triple your money, all those types of things. You're going to get between a 10, 12, 15% return on your money, somewhere in that range, right? Usually anywhere from 8 to 12% is standard. Anytime you get outside of people promising more than that type of return, you should know that there's some risk involved and there's a risk that you might lose everything. Now, there's always a risk that you can lose anything on everything on any investment. The higher the promised return, the higher the likelihood of a default is. And that goes across the board with all investments. So understanding that when you first get started, you want to invest in things that are safe so you can get that momentum going. And then from there, you can scale. And then as you get more experience and gain more capital, then you can put smaller portions of your money into riskier investments. A lot of times we hear about like celebrities or other people. Oh, LeBron James invested $4 million into Under Armour or something like that. And now that investment's worth $400 million. But what people don't understand is that $4 million to LeBron James is like $400 to us. That is a very, very small percentage of his net worth at that time.
Right.
So what I'm saying is you have to understand how to allocate your investments proportionately to the amount of risk. So you might say, okay, I have $100,000 to invest. I'm going to put 10,000 of it into something maybe somewhat risky, but has a high rate of return. I'm going to put the other 80 into, something that's just kind of mid-level or whatever. Just basically, long story short, understanding your investment capital and then how to allocate your investment capital according to risk and return ratio is something that a lot of people don't think about. They just want to go all in on one thing, all in on this thing, all in on that thing. But what you want to do is you want to make sure that you want to analyze the risk profile of each investment that you're in. And the higher the risk profile, the smaller percentage of your net worth or net investable income should be in that asset class.
Yeah, that makes sense because there's a higher downside, but there's also a higher upside. So you can put less in and make more from it if there's a higher risk involved, typically.
Right. So you look at if you're investing, like, let's just say, for example, into like venture capital. Let's say, I'm going to invest with some people, and they, I don't know, whatever, they're doing something where you could double your money somehow, or maybe doing a concert, they're starting a business, or whatever, things that, can generate that type of income. Okay, cool. I'll invest in something like that, but you ain't going to go all in on this type of investments because there's a chance that it could go to zero. Whereas with real estate investing, the worst case scenario, generally speaking, is that, you're going to have to fire sell the property, but you'll get some money back. So the security of investing in real estate makes it much, much safer than investing in businesses or, even some stocks and things like that, because of the fact that you have a hard asset that worst case scenario you could sell and get some of your money back.
Yeah. And that's all based on whether or not you buy right. Like you have to buy the property at the right price. You have to be all in at the right price in order for it to make sense. Because there's a lot of people who have bought houses, only a couple of years ago and trying to sell it now, and they're still holding the bag.
Okay, I won't say that they bought it the wrong time. I'll say they sold it the wrong time. That's a better way to say it. Because if you sell it the right time, it doesn't matter when you bought it. If you sell it at the wrong time, it does matter when you bought it. So if I bought a house in 2022, I was kind of on the back end of like the boom. And then now in 2023 or 2025, let me say that was years ago so fast. 2025, it was kind of in a downturn. So that same house that might have been 400,000 might be 350 now. Might be 380 in some areas. Just do it, kind of a give or take. One of my buddies always taught me, it's never a loss until you sell. It's only a paper loss, but if you have to sell, then you will lose money. So a lot of people are in upside down or whatever you want to call it investments, but if they can rent them out, if they can, float it, put it on Airbnb, whatever, then eventually they'll be able to come out on top on their investments.
Yeah, I like that. So let's talk about vertical leverage, because you're not just buying properties. You're managing funds. You're educating investors and redeveloping communities. So what systems allow you to juggle all those roles while keeping each machine running coherently?
You have to specialize in what you do best. So if you're in real estate development, there's many components of real estate development. You have, plans, permitting, land acquisition, the financing, the construction component of it, the sales component of it. And if you're renting them out, the rental component of it, the management of the property, the maintenance of the property, there's so many different things. So within those 5 or 6 different categories, what you have to say is, what do I do the best? Let me say that. And then find people in those other categories that you can trust. Now, that is certainly easier said than done, but that's how you do it. So I don't have to be at any of my construction sites because I have a great contractor. Now, of course, do I go there whenever I'm around? Yeah, of course, I'm going to check on it. I'm going to look at this, I'm going to look at that, but I don't actually physically have to be there. I'm not taking orders from suppliers. I'm not checking off. People not sending me their invoices. I'm not doing that. One of the things I would suggest to everyone to do is some sort of back end, an accountant, a CPA, some type of bookkeeping firm. Anyone who needs to get paid by you, they send the invoice to them. They'll have them sending you invoices. Are you being in charge of paying people? You want to make sure that you have a third party that handles all of your finances. Another great tool or tip that you can use to get all of those things kind of in one is an escrow account. So you can go to a law firm and set up an escrow account. And let's say, you put $100,000 into the escrow account. And then, each supplier sends their invoice to the escrow account. You approve the transaction, they pay them. and then you set up your terms. The other thing is you have to set up your terms properly with your vendors. So you can't have a guy who says, I'm finished now, I want to get paid now. Okay. If you have that, then that means you're creating an economic stress on yourself.
Everybody wants to do the work and everybody wants to get paid.
And everyone deserves to get paid.
The work done.
Right.
Right. People want to get paid, but they also want to get paid on time. But as long as you have the proper expectations. We had a builder developer that was on episode 1 of the Leverage Lounge podcast. And one of the things that they talked about is, how a lot of their trades, there's a lot of builders or developers that pay, 30 days out as a net 30. Many of these guys, they can't wait 30 days. And so these guys, they cut checks every Friday. If the work is done, yes, they inspect it and make sure that it gets done and done the right way. Because of how they pay their people and how they take care of their people, they have some tradespeople who's been with them for over 11 years already.
I just say about the national builders, you're going to be on net 30s or sometimes even net 60s. And this is what's even deeper than that. 30 days, you might have done 10 houses. Let's say you're a drywall man. It takes you, let's say, 3 days to drywall a house or whatever. Okay, you're doing 2 layers a week. You might be, 6, 7, 8, 9, 10 houses in before you get paid. And then there's any type of dispute. Long story short, that's what gives the smaller and mid-scale builder a little bit of an advantage over the national length, is the fact that we can pay people faster and people kind of are a little bit closer to the money versus a big company where, I got to send my invoice to the invoice department and 12 people got to look at it and then they got to approve it and then they're going to send a check, but only if you put the proper information, run the thing wrong, and you get paid for another 30 days. Like, it's crazy. That's why I think that it's important for smaller and mid-scale developers to get into the business because it creates a better environment for sales.
It's a healthy environment because now the trades have options, right? They can work with the national builders, but they can also work with the smaller guys. And there's going to be pros and cons to either one. Now let's talk about the community capital and grants, because you helped secure a $6 million grant for the Greater Bond neighborhood. So walk us through the strategic partnerships, community leverage, and frameworks that it took to make that happen.
Whether you like it or not, politics is a part of all of our life. We are all involved in politics. You're either a beneficiary of politics or you're a victim of politics, or you're neutral. But 9 times out of 10, you're either a victim or a beneficiary. So what I'm saying is, way more people could be on the beneficiary side if they understood how important it is. I don't think people understand how much money and resources flow through our local governments. Tallahassee, not that big of a city, a little less than 300,000 people, 200,000 people. Now we have over $1 billion budget every single year getting spent by our city. Over $1 billion. In our city, there are 5 city commissioners. So there are 5 people who are deciding where $1 billion are going to go every single year. When you're talking about billions, a lot of people are only needing 50,000, 100,000, 60,000 to change their life, to change their nonprofit, to change their whatever situation they got going on.
Yeah.
The money's there, but you just haven't taken the time to invest in relationships. So one of the things that we've always done is we've always invested in relationships. And what you're going to do is the key is aligning what you're doing and what you propose to do with the priorities of the city. So you have to read these boring reports that cities put out, right? They are boring. I'm not even going to sugarcoat it. They have a lot of government legalese that's not normal language for regular people. But read through them and see, what are they talking about? What are they prioritizing? What do they want? And how does that align with something that you want too? I think we all would agree we all want our neighborhoods to look nice. If one of the things that the city's proposing is neighborhood beautification, okay, bam, we got something in common. Now, that's where argument and debates and the come into play, but that's important, right? So aligning with what they want. The second thing is organizing. So we have a neighborhood association. We met regularly and showing up city hall meetings, showing up to other neighborhood events or other city sponsored events. Because sometimes I go to these city sponsored events and there's 5 people that will make. And I will say there are some reasons for that. I mean, due to the fact that usually city meetings are 11 o'clock in the morning and 90% of people have to work at 11 o'clock. So can you take out work to go to a city meeting? I don't know. They have some in the evening that's 5 o'clock, but you might have kids. It's not easy for the average person to do that. But what I would say is if you're anyone who wants to do something, especially in real estate development, is that you have to make, let me just say once a quarter, that you're sitting down and talking with someone from your government about what your priorities are, what you're looking for, and what they can do for you. But you have to understand how to create value for them. Don't look at it as you're asking them for money. That's the wrong way to look at it. Look at it as I'm helping you get reelected. If you start with that premise and that mindset that how can I help this person get reelected? What politician is going to be harmed a low-income neighborhood looking nicer? That's a great thing for them. They'll get to cut a ribbon. They get to do this. So what you need to do with picture in your head is how can I help them get reelected? That's something I can do for them that will help them get reelected, help them get some additional votes. So building new houses, cleaning up distraught areas, helping like elderly people, whatever, kids, things like that, things that get good media attention. If you focus in on those things, then they're going to come with you. And you also have to thank them publicly. They are public officials. So you have to thank them publicly. You have to get on social media and say, thank you for giving us this money. Even though we know it's all money, and they personally did not give us the money, but we have to personally give them credit because they voted for it. So it's not like they shoved a check out of their own pocketbook for this, but they did allocate it towards us, and we are appreciative of that because they did not have to. So the more appreciation, the more public praise and success that people can see with the money that they allocated, the better the outcome is for them. So if you think backwards at how you can make them happy, then and then how making them happy can also make you happy, that's how you get to the point where everybody wants.
Man, that's a bar. You're talking about starting with the end in mind, but I never thought about that question. How can I get you reelected, or how can I get them reelected? And then you're able to just, again, as we talked about in the beginning of this episode, where you saw a need and you serve it. Right.
Yep.
And so that's really cool, man. Another question I have for you, in a market that's chasing ROI, you talk about SROI, which is social return on investment. So how do you make that case to traditional investors? And then what KPIs really kind of move the needle in workforce and affordable housing?
Yeah. So the thing I tell people is I probably could I'm not going to promise anything. Let me not promise returns. I don't want to get myself in trouble. But what I'm saying is if you look at the returns from the products that I've done in the past, they are the same or if not better than any other investment that you're going to invest in real estate with faster turnovers and more impact. I can consistently get 20 to 30% cash on cash returns in affordable workforce housing all day long. I mean, easily. They have faster turnarounds and they have more impact. And they also create, what I'm trying to explain to people is, what I'm trying to get people to invest in these areas is that they create more opportunities for the luxury housing things that people want to invest in. Because when you clean up neighborhoods, you redevelop neighborhoods, now there's periphery areas. Now I can go build a shopping plaza. Now I can go build some little bit nicer apartments.
You're inviting that type of investment to come into the area now.
Exactly. Now you're creating a whole new possibility. You can, in major urban areas, you can build an A-class building right in the F neighborhood. I mean, you can do that. Only New York City, places like that where it's just tens of people and it's overcrowded. But generally speaking, your class A prime development can only come in either a rural area with no one lives, period, or at least a B-ish, C+ type neighborhood. Where it's okay, it's not the nicest neighborhood, but there's no crime, there's no violence, there's no, bunch of empty buildings everywhere and nonsense going on. So what I'm saying is if we can eliminate these D and C neighborhoods, these D, F, and even C neighborhoods, and make pretty much every neighborhood an acceptable neighborhood to develop in, then that creates way more opportunities for everyone. And then in addition to that, most people that I talk to, and this is something I'm really, really, really going to push harder, is that employers, the biggest reason why your employees keep going to you and asking you for raises is because of housing. So if you just invest in housing and stabilizing this housing market, so where your employees at the current pay they're at right now can buy a nice house and live a good life, then they're not going to keep coming back to you every year after year after year after year asking for raises because they can't afford to live quality of life. We want to stabilize the housing market so that, of course, prices are going to go up some, but it's a steady increase, not shoots up. I mean, most places in Florida have gone up 30% since 2021. I don't know very many people, unless they were in school or some are totally changed careers, who are getting paid 30% more now than they were in 2021. Unless they, like, you got a raise or, a totally position. But if you're in your same current position, there's probably slim to no way that you're making 41% now, more now than you were 4 years ago.
No.
This is not happening.
In the same job now.
At the same job, right? You're essentially asking people to work, and the point of people working is to live a quality life. But now you're asking someone to work hard but live a mediocre life. And that's bad for productivity. You want people to work hard, live a good life, they'll be motivated to get up on Monday and do it again. If I'm waking up, if I barely get paid my bills, what is my motivation to come in and innovate and make more money for the company and do this and do that? It's just not there. It's not the American dream. Now, what has made America what it can be is the fact that people can live a really good life if they work hard. But now people are working hard and living a poor quality life. And the reason why is because too much of our investment capital is going into impactless projects. I'm not going to say we don't need it. That's not the right word. But what I'm saying is, if you take the $1 billion that people built, that people spent on one high-rise in Miami, there's several high-rises in Miami right now that are being developed for over $1 billion.
Yeah.
If you took those $1 billion and invested that into affordable housing, the city of Miami would be better off for that. If you take the 50, 60, 70 million dollars that people are building at some of these apartment complexes and invest that into affordable housing, whatever city you name the city will be better off for that. So it's just about reallocating the resources into areas that make more sense for the economic health of the city. Because ultimately, at the end of the day, if you don't have workers, you don't got a city.
Yeah, that last part, absolutely. I want to talk about the elephant in the room as we're talking about this, though, because the elephant in the room is that once you get a nicer neighborhood that's already cleaned up, you have, let's call it an affluent neighborhood where the income is higher than the median income for that city or state, then you get a lot of people who don't want affordable housing in their neighborhood. They don't want this type of housing and attracting this group of people, if you will. That's not a race question. That's across the board, right? So they don't want that in their neighborhood. Nice homes, gated communities, Publix everywhere, and all of the fanciful things that come with nice neighborhoods that are great. I'm thinking about right now, I live in Windermere, which is a really nice, affluent neighborhood in just outside of Orlando, 10 minutes away from Walt Disney World. The average home price here is a lot higher than what the average home price is in most areas of Orlando, let alone Florida. But being that we're 10 minutes away from Walt Disney World, there's a lot of people who work at Walt Disney World that can't afford the nicest homes, right? Because they're hourly employees. And so they're trying to figure out this squeeze between housing affordability and keeping that job and hopefully getting that raise that you've talked about.
All right.
So they would love to live close to work, but if they live on this side, it's really tough for them to be able to find something affordable. And the people who might live in this area may say, well, I don't necessarily want them to build an affordable housing community right around the corner here because that might bring my property values down. So what do you say to that? How do we address that conflict? Because I'm sure you see it.
Yeah, absolutely. Affordable housing has been stigmatized because most people improperly associate affordable housing with low-income housing. And those are two totally different things. The low-income housing is like the projects where people are on Section 8. That's like the bottom, lowest component. When we're talking about affordable housing, we're talking about people who make anywhere between 70% to 120% of AMI, average median income, or the area median income in your particular city. So I'll use Tallahassee for an example. So in Tallahassee, someone who qualifies for affordable housing could make $90,000 a year. Now, if someone says, I don't want to live next to somebody who makes $90,000 a year, they're in a different time bracket than me. I don't know, if they find that's unacceptable, right? But for most people, that is a school teacher, that is a firefighter, that's someone with a, relatively decent job. Certainly not rich, but that's considered a successful person. When you consider the fact that the median income in America is about $50,000 a year.
Right.
So this is someone who's making about twice as much as the average person in this country. So when we're talking about affordable housing, we're not talking about the projects. We're not talking about the hood. We're not talking about any of the type of stuff. We're literally talking about, that's rather where workforce housing actually is a little bit better because it's harder to mistake low-income housing for workforce housing. This is literally housing for people who work in these areas. So, for example, don't we all love Chick-fil-A? Don't we all love Publix? Don't you think that the service would be better if the guy who works there could just walk across the street and go to work instead of having to drive an hour in the morning, drive an hour back home? I mean, just think about it. Like, and then what do we all hate? Who loves traffic? No one listening to this loves traffic. We all hate traffic. But do you know why there's so much traffic? It's because people cannot afford to live where they work. And they don't live where they work because it's for some reason, right? If people lived where they worked, there would be a lot less traffic. Now, of course, Atlanta's a little bit different because you got a lot of tourists, you got Disney, but there would be a lot less congestion if people just lived within a small radius of where they work. The reason why is because our cities need to be replanned. They were planned at a certain stage, and it worked at that stage. But think about, like, when Orlando first was developed and things happened in Orlando, it's a lot different reality of what's there now. Same with Tallahassee, same with Miami, same with any major city in Florida. They weren't envisioned to be this big and have this many permanent residents. Florida was always a place where people came for vacation. They came to relax. So most of the permanent housing in Florida was really being occupied by people who worked at Disney World, people who worked at hotels, people who worked at places to serve these wealthy people who came down to Florida for vacation. But now these wealthy people are going to actually live here. So now that created a whole different environment where now people who are working class people now have to compete with people for limited amounts of housing. So that's the issue. So we need a lot more housing. We need to develop a lot more debts. There's a lot of different things we need to do as far as our zoning codes to help alleviate that problem.
So let's get into the topic of impact, because you mentioned impact earlier. How are you using grants, investor capital, and public funds as leverage to multiply the impact of every dollar that you deploy?
Yep. Like you said, we call it in development, we call it a capital stack. You want to pull capital from as many different sources as possible. So I'll use my neighborhood as an example. Okay, bam. We got a $6 million grant from the city. Okay, bam. That's big. We built new sidewalks. We've renovated hundreds of houses. Then in addition to that, I've raised private capital from investors, maybe a couple other million, right, from that. Then on top of that, I've raised debt from lenders. So maybe all together between myself and my partners and whatnot, we've probably invested $30 or $40 million into our neighborhood just by leveraging different sources. So leverage is the key in real estate, is that you know, leverage your grants to do the hard work. So go in, do the hard work, get the dirty houses, the ones that make sense financially, yada, yada, yada. Use the grant money for that. The ones that make sense in the market, don't use grant money for that. Just use the private market for those. And the biggest mistake a lot of people make is that they're using grant money and government money for products that are already profitable without any government assistance. So therefore, you're just wasting government money. If I could just build a house and sell it on the open market and make a profit, I shouldn't be going to the government asking for a subsidy. I should be going to the government for products that don't make sense financially, but that need to be done to fix the neighborhood. So we've all been in a neighborhood where there are like 2 or 3 houses that just look horrible. But the owner, for whatever reason, says, I'm not selling unless you give me this crazy amount, which is way over what it's worth. If I could go to the government and say, hey, listen, man, these 2 houses are ruining this entire street. If I had 100,000, another 100,000, another 200,000, I could just buy these houses, get these people out of there, and we could renovate the whole street and make it all make sense. That's what grants should be used for. Okay, we have someone who wants to start a business in this neighborhood. The demographic's not quite there yet, so they need some help getting started. Let's give them a grant.
They're kind of ahead of their time.
Exactly. But it's the cart before the horse. It's like, do people move the neighborhoods and then you develop the commerce? Or do you need to bring the commerce to the neighborhood and then people are going to live around the commerce? I mean, it's a combination of both. There's not necessarily a right or wrong answer there. What I'm saying is that's the key. So this is where you need the government. You need the government to create the environment, to create the opportunity, and then you need the private sector, which is made up in 2 components. Your equity, which is your equity investors, and then your debt, which is like your banks or the lenders, to come in, and then bam, you can make a huge impact with not that much money. So if you took any given neighborhood, I mean, obviously there's different sizes of neighborhoods. I'm going to say smaller neighborhoods, you get a couple $1 million from the government. You raise another $5 or $10 million in private capital, and then you go out and use bank money for the other 10, 20, 30 million. You can bring about $40 or $50 million into any given neighborhood relatively quickly. And if you do that, you can really turn that neighborhood around within a 4 to 5 year time frame and get it back to where it needs to be.
So let's talk about the buying in the path of progress. I know a lot of real estate investors, they're always looking to buy in the path of progress, which is simply buying residential real estate investment properties usually when they see certain things that are happening in a nearby area. They see the growth coming from a nearby area. Maybe that area has already been built out and now it's time to expand because they have to go somewhere. That growth is going to keep on going, whether it's up an interstate or into a new area. How do you find that path of progress? What do you look for, or what should investors look for in order to get ahead of the curve that we were just talking about before investors start coming in and prices begin to rise?
Every city has to publish a 20-year plan, a 50-year plan, maybe various different stages in different cities. So like right now, I'll use Orlando as an example. Orlando is now talking about 2050 and what they want the city to look like in 2050. So a lot of people are like, oh my God, that's 25 years from now. There's a restaurant Orlando, we remember 2000. 2000 was 25 years ago. And just think about what did Orlando look like in 2000 and what does it look like in 2025. It's a very different place. But based on that, you know that in 2050, it's going to be a different place. But what they've done in that report is they've told you the areas that they want to emphasize development in. They've identified this neighborhood, that neighborhood, this neighborhood, that neighborhood. So what you need to be doing is going in now and buying in those areas. And then going to the city and saying, hey, I see that you want to develop in Paramore or whatever. I'm just naming some random neighborhoods. I have 5 properties in Paramore that I'm looking to develop. Can you help me? All of a sudden, now they can help you. But what happens is people wait until they're going to be in 2051 asking for money for the stuff for 2050. But by 2050, guess what they're going to be selling for? 2075.
Right.
You see what I'm saying? So right now, you need to be asking for the things that they want to see by 2050 because the government is going to give itself plenty of time. So I was watching a YouTube video talking about the development of Orlando, and they're talking about like expanding some of the highways and other things. Like the contract that they have with the highway people to expand the highways is for 30 years. It's going to take them 30 years to expand this highway. It's going to happen, but it's going to take a long time. So what I'm saying is, where they're going to build the new interchanges, what's going to be in those places, finding that out and getting in and getting land in those areas is going to help you to be able to get the financial return that you really want.
So should somebody be looking at land in those areas, or should they be looking at the properties that are already built in those areas? Because if you're buying a rental property in that area that is 20 years from the height of what it could be or will be, then those rents may not match up to what you bought the property for. The numbers may not make sense at this point in time. What do you do when it's still maybe not necessarily depressed, or maybe it is a depressed area, and you know that in 20 years or 15 years, it's going to be something, but we're not quite there yet? Is that where the grants come in?
Yep. So that could be where the grants come in, but that also is you still have to buy right. There's never a time to overpay for a property unless you just have some type of like rare insider knowledge that you know something that no one else knows. You know, if you buy a property and you're expecting to like turn quickly around and make money on that property, it's not going to work like that. But if you know that one day, and that one day could be 5 years, that one day could be 10 years, that one day could be 20 years. So that is my plan to manage that property during that time. So I would not buy land in those areas unless you have capital that you can afford to just sit on. People who did this, I would say, give you examples. Met a bunch of people who bought a bunch of lots back in the 90s, early 2000s in some cities for like $500, $1,000, and they were selling them. Those lots now are selling for 30, 40, 50 grand. So, you know, if you bought 10 lots for $1,000 and you sell them for 30,000, you turn 10,000 into 300,000. That's worth waiting 20 years for. That's basically your retirement. So there's people who do that type of stuff. So you have to be getting them at very, very, very cheap prices if you're going to be holding them that long. Now, if you want to buy houses at that price, you can, but you have to be able to make sure that they're going to be solid rental properties. And you have to identify the type of property that's a low maintenance property. So houses that, you know, you want to get houses that don't have a lot of stuff that can break. So you want to look at how old is the roof, how old is the HVAC, how old is the plumbing, how old is the wiring, you know, those type of things. If they're not recently updated, you're guaranteeing yourself a bill. Especially talking about holding something for 10, 15, 20 years. Sadly, the roof, you're going to have to replace it. That's a given. Maybe electrical. Who knows what the codes will update 10 years from now. So things can happen, right? So long story short, what I would be doing is, if I were investing in an area like Orlando or some general area like that, a city that has the potential for rapid growth, I will be buying properties in areas that have been rezoned that people don't know about. So areas when you can buy single family homes and tear them down and build duplexes, or you can buy a single family home and split the lot in half and build 2 houses. Those are the type of deals that you can make that you can do very, very, very well on over time. That's what you should be looking for in cities that have a lot of potential for growth, is finding houses with big lots. Now, if you have more money, then you can go buy the big acres and all that type of stuff. It depends where you're at financially. But let me say, an average person, I would buy a house on an oversized lot that I could potentially just tear down eventually and split into 2 lots, or split and build a duplex or a triplex or a quad or something more dense that could be worth a lot more money later. Or at the bare minimum, build another house in the back or ADU in the back.
Yeah. How does one find that information? How do you know if an area has been rezoned? Do you have to be targeting an area and then research it? Or is there somewhere that kind of talks about what the rezoned areas of a certain city might be?
Yeah, so that's probably on the exact road. I know Atlanta has something like Vision 2050 or something to that effect. Other cities have different names for it, but they'll basically tell you what they're looking to do. So we got to do the research. So the key to real estate development, right? Let me put it like that, is that you really got to understand the neighborhoods very, very, very well. What I suggest people to do is narrow down. I know we're talking about scale here, but you really kind of got to narrow down your neighborhood choices. So I got a couple of little areas, couple of neighborhoods I'm really interested in, and I can scale within that neighborhood. Because any given neighborhood has hundreds of millions of dollars worth of houses. So you really only got to develop in one area to make whatever amount of money you need to make. If you can do 50 houses in one neighborhood, that's plenty. You know what I mean? You can do that relatively easily. Some neighborhoods, like my neighborhood has 700 houses. And there's no way I can get all 700 of them, but I don't need all 700 of them. Even if I get 10% of them, that's 70 houses.
Yeah, I appreciate you telling me that, because I know that that's probably on the listener's mind, is how do I even begin to make that work?
So one thing I would suggest everyone to do is go out to the planning department of your city and just talk to them. Just ask them, just sit down with them. There are people who are within the planning department whose job is to deal with the public. The average person may or may not want to talk to you, but that's their job. So let them go down there and say, hey, listen, I'm looking to get into development. I'm looking for areas where we can build duplexes or triplexes. Are there any areas that have been recently rezoned where they're allowing more density? And let them tell you where to go, because they know. The planners know. So get with the planners in your city, build a relationship with them, and that leads you to the opportunities.
Yeah. That's good to know that I've always heard about going down to the planning division, but I didn't realize how easy it could be to do it. So that's good. You've written 2 books.
Yes,
to my knowledge. You wrote a book on Somali piracy as well as the South China Sea.
Yes.
And
exactly.
so your research on energy conflict and piracy seems like it would be worlds apart from real estate. But how has that geopolitical understanding helped you to assess risk and opportunity in these underserved neighborhoods?
Understanding politics helps you to work with city government. So because I understand politics on an international, national level, it's all about creating a win-win situation. So the reason why there's a conflict in Somalia, the reason why there's a conflict in South China Sea, is because they haven't found that equilibrium of win-win where everybody could be happy. And that's the key to any different negotiations, is making sure that both people win.
Yeah.
So if you can create a situation where both people win. So for example, someone has a property that they're not doing anything with, and they need some money. Okay, I can give them some money, and I can get the property, and I can make money on the property. I create a win-win. So what I learned from any type of all the international diplomacy, all the international relations, is that finding out what the other person wants and figuring out a way that you can give them what they want and still get what you want is the key to every negotiation.
That's good. Yeah, because most people see housing as like a local game, but your playbook has more of a global feel.
Yeah.
You take insights from international diplomacy that helps you lead with strategy instead of hustle. And
Right.
I think that's brilliant. You wouldn't normally think that those two go together, but obviously they do. You've also created educational programs like buy your first investment property in 6 months. So what automations or leverage tools that you use to teach at scale without burning out?
The simplest one is Zoom. I use WhatsApp, Facebook groups, and I do a lot of in-person things as well. I found in general that it's less draining teaching in person than it is online. Online, because the screen, it can drain you physically, But in person is a little more energetic because there's a lot more of exchange of energy. So in person is less scalable, but it's more intimate. But online tools are great places to start. The biggest thing that we do is I teach people to create a criteria and stick with it. So like on my first round of mentees, I tell them, listen, find any house that's 3 bedrooms, 2 bathrooms, under $100,000. Go find those and bring it to me, and we're going to pick the best one out of that. And that's going to be your first deal. And every single time we found a deal out of that category. Now I probably have to change the scale because things got more expensive. But what I say is I just give them a set category of what to look for, and you're going to find a deal within that category because I know the numbers. And it's the same thing. So whatever city you're in, you can find a mathematical formula of what price point needs to be at in order for it to be a deal and go straight to those. It might be 1, it might be 100, it might be 500, it might be 2, but you have those 2 opportunities. And then figure out how can you close on those 2 where there's a deal. If you can't find those, then you got to start calling. So you get on the phone, you start calling people and seeing if you can find someone who's willing to sell within that price point that you want. So it's all about having your number and knowing exactly what you want, and then grab the people with a plan of action, because people respond better to plans and leadership than people who are kind of like going back and forth.
Going through this process myself right now, I'm going to be hitting you up too, because I was at one point accumulating rental properties. I was flipping homes. And then I got to a point where I had a couple of bad flips. I had some crazy stuff going on with an investment partner that I had, business partner who actually never invested, I should put it that way. And so I needed capital. So I ended up having to sell off a lot of those projects. And so I'm at a point where I know that that's part of my path to freedom is buying investment properties that have a great return, but also making sure that I'm being a good steward with the funds that I do have to make sure that this is sustainable. I don't want to just parking all of my funds into one project and then one property, and that's all I can do. I'm looking for smart ways to do that now. So you and I can continue to talk about that as well. But I want to talk about your org chart, scaling with leverage behind the curtain, because you teach at SCAD, you run a fund, and you lead redevelopment projects. What are the key leverage points that make your operations sustainable?
So that's the key thing. So all like your admin stuff has to run through some sort of secretary or assistant in that category, right? Then you need your project management people. So I have several project managers who are leading those projects. And then in terms of finding new deals, we also have another team of people who work to find more deals. Most of my stuff is dealing with the finance, because I'm the one that's raising capital and make sure all the financials and the capital behind the deals make sense, and make sure we're going to make money, and make sure also we can get our investors a good return on their money. Because I kind of started during the pandemic, everyone's like scattered all over the place. So now we're working on like kind of like putting everyone under one umbrella. So in terms of maybe a location, some people like Tallahassee, some people don't like Tallahassee. So maybe I'll open an office in like Miami or Orlando or someplace people like a little bit more. And then everyone can kind of be under one roof. But right now, my team is pretty much scattered out all over in different places.
So Chris, before we let you go, man, I want to hit the lightning round. Some quick answers only. All right. Favorite book you recommend most?
Ooh, Pitch Anything by Warren Clough.
Okay. All right. Why is that book?
It teaches you how to raise money. If you want to be a successful business person, you got to be able to raise money. If you can't raise money, you got to be mediocre.
Okay. There we go. Most underrated investment strategy right now?
Build to rent. That's the best one I could think of right now. Build to rent.
Okay. Build to rent. I see a lot of actually build to rent communities popping up all over the country now.
We're in this for investor nation, whether we like it or not. So build to rent, get ahead of the curve.
Okay. I like it. What's one habit that changed everything for you?
Outsourcing. So just being able to trust other people and build teams and just trust other people allowed me to have a lot more in my life back, a lot more of my time back.
Yeah. That's even harder when you've been burned before, but it's vital. The best advice you've ever received?
Learn from the mistakes of others.
I like
So instead of making your own mistakes, learn from other people's mistakes and avoid them. That's probably the best advice I would get. Very simple, but very real.
what we call collapsing time, right? Doesn't have to take you as long.
Exactly.
Learn from other people's mistakes.
Yep.
All right. Last question. What's something most people misunderstand about building wealth?
Biggest thing that most people misunderstand about building wealth is what wealth is. So wealth is not just a dollar sign. wealth is also the quality of life. You can have a lot of money, but if you don't have any free time, if you don't have good health, if you don't have good friendly relationships, if you don't have everything aligned, then that money won't mean anything. So having a more holistic approach to wealth will actually increase your actual wealth and your happiness.
Yeah. All right. I have one more question selfishly. What's the 5% of your business, the one thing that you protect at all costs because it moves the needle more than anything else?
Your reputation. There's nothing that you can replace your reputation. Your reputation and your trust are the most important thing. You can lose money. You can mess up on a deal if things go wrong. But if you maintain and preserve your reputation and the trust that you have with other people, you say, listen, this happened and they're wrong, things were bad, but this is the way out. As long as you have a good reputation and a good face, you risk your bounce back.
Great job, man. Well, hey, you are officially off the hot seat.
All right.
You did great.
Appreciate it. Thank you.
So, Chris, where can people connect with you? Whether they want to learn more about your investment education platform or stay plugged into your work or buy your books, whatever.
Yeah, absolutely. So you can find me on Instagram. My Instagram name is Chris Daniels 1887. I'm also on Facebook, Christopher Daniels. I'm on LinkedIn, Christopher Daniels as well. On TikTok as well, Chris Daniels 1887. So just find me on any social media and just shoot me a DM and a message and we can connect.
And we'll have all of his details in the show notes as well as his website and the name of the course and everything else if you want to get more information on that. Thank you, Chris, man. I appreciate you. Guys, that is a wrap for this week's episode of the Leverage Lounge podcast. If you got any value from today's conversation, do us a favor. Like, follow, and subscribe on YouTube, Spotify, and Apple Podcasts. And share the wealth. Share this episode with a friend who you know needs to hear it. Maybe even just wants to hear it so you guys can get this thing going. Also visit leveragewithmike.com for more tools, resources, and leverage building insights. Hey, I'm your host, Mike Collier, reminding you that real growth starts when you stop doing it all yourself. So let's scale smarter. See you next time.